This is how to draw trend lines.
No, this is how to draw trend lines.
Funny goons, this is how to draw trend lines.
Give me that. This is how to draw trend lines.
In this session, we'll dive into how to effectively identify and trade with trend lines to maximize your trading potential. By the end of this video, you'll understand how to draw trend lines properly, how to use them to confirm trends, and most importantly, how to integrate them into your trading strategy. Let's get started. A trend line is one of the most fundamental and simple tools that traders use in technical analysis. A trend line represents a line drawn between two or more price points on a chart. This line is used to identify the direction of price movement, and it helps to visually illustrate the prevailing trend in the market. Think of them as the diagonal equivalent of horizontal support and resistance. There are three types of trends you should be aware of. The uptrend is created when the price is consistently moving higher, making higher highs and higher lows. A trend line drawn under the lows connects at least 2 points. The downtrend is created when the price is moving lower, creating lower highs and lower lows. A trend line is drawn above the highs, connecting 2 or more points. The sideways or range-bound trend happens when the market is consolidating and moving within a horizontal range. In this case, you would draw support and resistance lines rather than a single trend line. Trend lines can be used to identify trends, potential reversals, and areas where price might react, such as support or resistance zones. Now, let's move on to how you can draw trend lines correctly. Before you can identify trend lines correctly, you need to know how to identify swing highs and lows in the market. To identify swing highs and lows, you need to see a significant drive away from a price point. It's either a massive pull from the price point or a gradual but prolonged move away from a price point. Once you're able to identify swing highs and lows, drawing your trend lines become quite easy. For an uptrend, you need to connect at least 2 or more significant swing lows. These are the points where price has moved down and then reversed upwards. Draw your trend line from the first low and extend it towards the next low, ensuring the line touches the lows but doesn't cut through the candles. Don't worry, it can be at the tip of the wicks, in the middle of the wicks, or just at the tip of the body. The more touch points you have on the trend line, the more reliable it becomes. In this example, you can see a major swing to the upside, marking our first swing low. And as price gets back down, we wait for another swing low, so we can connect the dots to make our trend line. As you can see, price surged up after it got to this point. Therefore, we connect the first swing low and the second swing low and extend it to form a key area to predict price in the future. Notice how the price respected this line to continue the uptrend. Can you identify the trend line in this chart? In a downtrend, you'll connect at least 2 or more swing highs where price has moved up before reversing downward. The trend line should connect the high points, and you'll want to ensure the line doesn't cross through the price action. Here's a downtrend example. You can see swing highs forming, and the trend is drawn above them to connect the swing highs. Each time the price approaches this line, it tends to reverse down. Identify the trend line in this chart. Ideally, a trend line should have at least 2 touches to be considered valid. A third touch right after a second touch still counts as a second touch if there was no vivid swing from the initial second touch. After you mark your trend lines, placing horizontal lines on significant swing highs and lows can give you more information about the state of the market and usually help you to identify unexpected chart patterns, with common ones being the flag patterns. Note that the steeper the trend line you draw, the less reliable it is going to be and the more likely it will break. The best angle for a trend line is roughly about 30 to 45 degrees. 2 trend lines can come from one swing high or low if price is still in the same trend. The higher time frames will always produce the most reliable trend lines, so start there and work your way down. A break and retest of a trend line that had 3 or more touches can often mean a reversal in the market and a potential buying or selling opportunity. A major break after third or further touches on the trend line makes the trend line invalid for the future. Look for a new one. Never try to force a trend line to fit. If it doesn't fit the chart, then it isn't valid and is therefore not worth having on your chart. Technical traders are sometimes convinced that a level should exist. The trader begins to try to make the level fit the price action on the chart. You should note that the best trend lines are the most obvious ones. So if a trend line doesn't fit well, it's probably best to move on to another pattern. Now that you know how to draw trend lines, let's talk about how to actually trade using these lines. Trading with trend lines is all about finding points of entry where the market respects the trend line, providing high probability trades. The first one is the trend line bounce. A common strategy is to look for price to bounce off the trend line, continuing the trend. In an uptrend, look for price to pull back towards the trend line. When price touches the trend line, you can look for a bullish reversal pattern, such as the bullish engulfing or a hammer. In a downtrend, look for price to approach the trend line from below. When it reaches the trend line, look for bearish reversal patterns, such as the bearish engulfing or a shooting star. The most high probability candlestick patterns when it comes to trend lines are the engulfing candle and the evening and morning star. Here we have an uptrend, and price comes down to touch the trend line. It forms an engulfing candlestick, signaling a potential bullish reversal. You enter a long position here with a stop below the recent low. Note that there can be a trend line bounce in another trend line bounce. Both can be traded. Let's take a look at this example while you answer some questions. Where's the trend line? Can we trade from here since it gave us a candlestick confirmation? Number 2 is the trend line bounce with opposing microtrend strategy. This price structure usually has the main trend created and an opposing microtrend build up to touch the trend, usually creating a flag pattern. If price breaks the microtrend line, this further indicates a strong trend continuation of the main trend. For a downtrend, the opposing trend should be an uptrend and vice versa for the uptrend. With this strategy, if price fails to give confirmation when it touches the main trend line and still breaks the microtrend line, you can enter the trade on candle close. The next is the trend line break strategy. A trend line break can signify a trend reversal or a breakout. When the price breaks above a downtrend line or below an uptrend line, it may indicate the end of the trend. If a trend line is broken to the upside in a downtrend, traders might enter a long position, anticipating an uptrend. Similarly, if a trend line is broken to the downside in an uptrend, a short position could be taken. The best way to trade the trend line break is to wait for a pullback to a support or resistance, or to the trend line or zone, and enter the trade after a candlestick pattern confirmation. Here's an example of a downtrend, and the price breaks above the trend line. This signals a possible reversal. You could enter a long position after price comes back to the support or trend line. Let's take a look at this example. Where's the trend line? Should we trade right from the breakout? Is this a confirmation? Another strategy is the trend line break with opposing microtrend scenario. Just like the trend line bounce with opposing microtrend, there is also a trend line break with opposing microtrend. An opposing microtrend builds up to touch the main trend line, but price actually breaks the main trend, signifying a strong trend change. With this strategy, price should be allowed to come to the support, resistance, trend line, or zone with a candlestick confirmation before entry. The same goes for an uptrend. And lastly, the trend line confluence. Combining trend lines with other technical tools can significantly improve the accuracy of your trades. This is called confluence. For example, if the trend line aligns with a major Fibonacci level or a support resistance level, it adds weight to the validity of that level. The more indicators that align at the same level, the higher the probability of a successful trade. In this scenario, we see a trend line meeting a key Fibonacci level. The price approaches this area, and we get a candlestick pattern signaling a potential reversal. This is a high confluence trade setup, making it more reliable. While trend lines are powerful tools, it's important to manage risk effectively to ensure that your trades remain profitable over time. Place your stop loss just below the trend line in an uptrend and just above the trend line in a downtrend. If the price breaks the trend line, your stop loss will help limit your losses. Always ensure your trades have a good risk-to-reward ratio. For example, if you're targeting a 100 pip move, aim to risk no more than 30 to 40 pips. A risk-to-reward ratio of at least 1:2 is ideal. A trend that is clear on the daily chart might be less reliable on the 1-hour chart. Look for alignment across timeframes for higher accuracy. Don't just rely on a trend line break. Confirm it with volume, price action, or other indicators to avoid false breakouts. Before we wrap up, let's cover some common mistakes traders make when using trend lines and how to avoid them. Don't rush into drawing trend lines. Make sure they're properly placed, and don't force them onto the chart. Patience is key. False breakouts are common. If price breaks the trend line but doesn't continue in the new direction, it may be a false breakout. Wait for confirmation before taking action. As price action develops, your trend lines may need to be adjusted. Keep an eye on evolving trends and modify your trend lines accordingly. That's a wrap on today's lesson on how to identify and trade with trend lines in Forex. By incorporating trend lines into your strategy, you can better understand market movement and improve your chances of success. Remember to practice, be patient, and always trade with proper risk management. As you become more experienced, you'll be able to spot trend line setups with greater accuracy and confidence. Thanks for watching, and happy trading!